Welcome SIE candidates. Thank you for studying with us as we prepare you for the SIE exam. As we conclude the SIE series, let's start with investment risks. Investment risk can generally be defined as the chance that an investor loses money. Some risks are specific to individual companies, while others affect an entire asset class of securities. This video will examine several types of risk and explore ways investors try to reduce potential losses. When recommending specific securities or financial plans to clients, financial professionals must consider various factors. These include the client's financial holdings, risk tolerance, investment goals, and related risk factors. This first section will highlight some key risk factors that registered persons should discuss with clients before making recommendations. The concept of diversification will also be explained, which simply means not putting all your eggs, investment dollars, in one basket. One example of diversification is buying shares of a mutual fund that owns a broad range of stocks, instead of investing in just one stock. To expand on diversification, let's discuss risk more deeply. Investment risk falls into two main categories: diversifiable and non-diversifiable. Systematic, non-diversifiable risk. Systematic risk is caused by factors that impact nearly all securities prices. Interest rates, recessions, and wars are sources of systematic risk because they influence all markets to some extent and cannot be avoided through diversification. Here are different types of systematic risk. Market risk. Market risk is the daily potential for investors to face losses due to fluctuations in security prices. Any security bought or sold can decline in value as it's traded. During a sustained bear market, most stocks tend to trade lower regardless of how well the individual companies are performing. Beta measuring non-diversifiable risk. Avoiding diversifiable risk is as simple as building a portfolio of assets that don't move together, unrelated. However, non-diversifiable risk requires a different approach because the risk level is directly related to the expected return. The non-diversifiable risk of a portfolio or asset is measured as beta. Beta indicates the risk of a portfolio or security compared to the overall market, measured as volatility. The market, often represented by the S&P 500 index, has a beta of 1.0. Stocks or portfolios with betas above 1.0 are more volatile than the market, while those below 1.0 are less volatile. Most market professionals use beta to describe the volatility of stocks. Interest rate risk. As mentioned earlier in the series, interest rate risk mainly affects existing bondholders. If interest rates go up, the market value of their bonds will fall. If rates rise, new investors won't want to buy existing bonds at face value, $1,000, because they can get higher yields from new bonds with higher coupon rates. To attract buyers, the prices of existing bonds must be lowered. Diversification. A mix of bonds from different issuers, with varying coupon rates, maturities, and locations, can protect against some risks, but not interest rate risk. Since all bonds are subject to interest rate risk, it's considered systematic or non-diversifiable. Duration. Bonds with longer maturities are more vulnerable to interest rate risk than those with shorter maturities. Also, bonds with lower interest rates are more sensitive than similar bonds with higher coupon rates. Duration measures how sensitive a bond or portfolio is to interest rate changes. It's expressed in years, and a bond's change in price is roughly based on its duration. For example, if a bond's duration is 10 years, a 1% rise in interest rates could cause a 10% drop in its price. Some investors reduce the impact of interest rate risk by laddering their bond maturities, spreading holdings across different durations. Interest rates and equities. Stock prices can also be affected by changes in interest rates. For instance, rising rates tend to hurt utility stocks because these companies borrow heavily. However, stocks like those of defensive companies, for example cosmetic firms, are less affected thanks to their business nature and low-cost products. If rates rise, preferred stocks tend to react similarly to debt securities. They tend to decline when interest rates go up. Inflation purchasing power risk. Inflation risk affects investments that give fixed payments such as bonds and fixed annuities. Inflation, the rising cost of goods and services as measured by the Consumer Price Index, CPI, erodes the real value of money, decreasing its purchasing power. Historically, assets like stocks, variable annuities, real estate, and precious metals, gold, silver, have offered better protection against inflation. Inflation hurts bondholders because it causes interest rates to rise, lowering bond prices, and diminishes the purchasing power of interest income. As previously mentioned, many market professionals measure an investment's real rate of return, For bonds, it is also called the real interest rate. The formula for calculating the real rate of return is an investment's return minus the inflation rate, measured by the Consumer Price Index, or CPI. For example, if an investment yields an 8% return and CPI is 3%, the real rate of return is 5%. Event risk. Event risk is the threat that a major event will cause a significant drop in the market value of all securities, such as the 9/11 terrorist attacks. Unsystematic, diversifiable risk. Unlike systematic risk, unsystematic risk depends on circumstances unique to a specific security and can be managed by diversifying assets in a portfolio, such as by choosing stocks with different risk and return profiles. The following are various types of unsystematic risk. Alpha. As mentioned earlier, beta measures how volatile an investment is compared to the overall market. However, alpha indicates the risk specific to a particular company. Using beta, investors can estimate a stock's expected return. Then, alpha is calculated by subtracting the expected return from the actual return. For instance, if a stock's beta predicts a 5% return, but it actually earns 8%, then alpha is 3%, 8%, 5%. Conversely, if it earns only 4%, the alpha is minus 1%, 4%, 5%. Business risk. Business risk is the chance that certain conditions or factors could negatively impact a company's operations or profits. For example, a business's prospects may weaken due to increased competition or lower demand for its products or services. Regulatory risk. Regulatory risk concerns the potential negative effects on an investment's value due to changes in regulations. For instance, if the FDA denies approval for a new drug, the stock price of a pharmaceutical company could decrease. Legislative risk. Legislative risk involves the potential adverse impact of new laws on an investment's value. Laws can change at any government level and affect various types of investments. For example, raising the legal drinking age might reduce sales for a beer producer. Political risk. Political risk refers to the possibility that foreign investors could lose money because of government or regulatory changes in a country. This risk is common in emerging markets and can include wars, terrorism, or coups. Liquidity risk. Liquidity risk is the danger that investors may not be able to sell a security quickly or at a price close to recent market values. This risk rises as trading volume declines. For example, shares of large blue-chip firms are highly liquid, while small company stocks are less so. Investments not traded actively, such as hedge funds, private placements, direct participation programs, limited partnerships, and real estate, tend to have low liquidity. Opportunity, cost, risk. Opportunity cost, or opportunity risk, is the chance that an investment's return will be lower than that of a different investment not chosen. For example, an investor might plan to hold a bond until maturity and thus not worry about a potential decline in its price if interest rates rise. After all, as long as the issuer doesn't default, the investor will receive the bond's face value at maturity. However, this approach ignores the higher returns that might have been earned from an alternative investment. Reinvestment risk. Reinvestment risk is the chance that an investor won't be able to reinvest the principal at the same interest rate after a bond matures or is called. This is common when interest rates decline. The investor then faces two options: accept a lower return or take on more risk to maintain income levels. Reinvestment risk also occurs when market interest rates fall, and the investor must reinvest interest payments at lower rates. Currency, exchange rate, risk. Currency or exchange rate risk is the possibility that foreign investments will decrease in value due to changes in exchange rates. For instance, if an American owns a British stock paying quarterly dividends, the actual value to the investor drops if the British pound weakens against the US dollar. This is because the dividends received in pounds will buy fewer dollars when converted. Foreign securities, international funds, global funds, and ADRs all carry significant exchange rate risk. Currency risk can also affect the price of a US-based company if it earns revenue from abroad. For example, a US company sells its products and services in Europe and earns revenue in euros. If the US dollar appreciates or becomes stronger, the euro will decline, causing the dollar value of this revenue to decrease. Additionally, if the dollar strengthens, the company's products will become less competitive in Europe, leading to reduced exports. Capital risk is the possibility that an investor could lose all or part of their investment. Purchasers of options are especially affected by capital risk because if the options expire worthless, the investor loses 100% of their capital. Conversely, if an investor bought a stock at $50 and it dropped to $40, her loss would be 20%, a $10 loss divided by the $50 purchase price. Credit risk, or default risk, is the chance that a bond issuer will fail to make payments as promised. U.S. Treasuries are considered to have virtually no default risk. The credit ratings agencies discussed earlier provide information to market participants about the credit risk associated with an issuer's bonds. Call risk is the danger that an issuer may decide to repay its bondholders before maturity. Bonds are generally called when interest rates fall. In such cases, bondholders get their money back early and miss out on earning the same returns they could have obtained with new investments. Prepayment risk is specific to mortgage-backed securities and related to homeowners paying off their mortgages early. When interest rates decline, homeowners are likely to refinance and pay off their existing mortgages. These prepayments are passed through to the pools holding the original mortgages. At this time, pass-through investors must reinvest the large amount of principal at lower interest rates, which makes it difficult to match their previous coupon rates and returns. Diversification is a strategy to control risk by spreading investments across various asset classes according to a client's risk tolerance and investment goals. This process, known as strategic asset allocation, aims to create the best mix of assets for the client. Over time, different asset classes may provide varying returns, which can cause the original allocation to drift away from the initial setup. There are many opinions on how to handle shifts in asset allocation to ensure the best outcome for clients. To keep things simple and clear, we will be brief and direct. Join us for a follow-up video where we continue this discussion. As always, please like this video so others can benefit. If you're new here, we invite you to join our community with a free subscription.